Right, good morning everybody. We've got quite a bit to go through this morning, so I think we'll get started. So welcome to the pavilion, and welcome to everybody who's watching this morning on the live stream. So at last, it's here. The speculation sort of around this budget has been pretty intense. Giving us more drama than the latest sort of Bridgerton series, and probably equally as painful, to be honest. So at last, sort of after the last 16 weeks, we can at least give you some clarity on planning forward, really. So to run through this morning's agenda, Richard is going to start by giving us the main points of Wednesday's budget, and then I'm delighted to be inviting back Luke Pearce from Rowan Dartington, who's our stockbroker arm of St James's Place, which a lot of you will now know. Luke's going to give us a full review of the markets and give us some pointers on really what we think may be the main topics to affect them going forward. After that, Richard's going to give us a general update on some other topics I think that might be useful, and then we will have a question and answer session after that, which I think, with the budget the way it's been, I think we may have a few more questions than normal perhaps today. So we'll answer as many of those as we can. If you can hand your feedback sheets in, please, before you go, to the ladies at the back, and then we'll try and answer those over the next few weeks as well for you. So hope you find this morning useful, and I'll pass over to Richard and we'll get started. Thank you.
Morning everyone, lovely to see you all, and sorry about Weatherby Road, the Skipton Road, the roadworks, everything, keeping Britain and Harrogate going, but there we go. A lot to talk about, and let's go straight into it, because it seems as though a lot has changed. Actually, how much has changed for you as individuals, we'll tell, and everyone will be different. Unfortunately, the winners list is slightly limited this year, but if you've got particularly an 18 to 20-year-old, the minimum wage for them has risen by 16% to £10 an hour. So they are winners. Drivers, we don't have any more fuel duty. Drinkers, it's 1p off a pint. And high street retailers, the business rates have been continue to be frozen. So some limited positive news for those winners. The big headline for those of you who are not in the public sector and have defined contribution pensions is they will be taxed from April 27 as part of your estate at death. Obviously, poor old employers have had the NI burden going up from 13.8 to 15% and the threshold going down. So there's a substantial increase in employers' national insurance, and already coming through now is where it will hit, and in particularly the care sector, where many people are on fairly low wages and quite a high level of low paid. That's going to be quite cruel. Investors are hit because of capital gains tax. That was widely forecast. Rates didn't quite rise as much as we expected. I'll talk about it. Clearly, business and farmers really quite left-sided and exactly the opposite of what the Labour Party had told certainly farmers and many business owners last year. Landlords, because stamp duty for second property owners has gone up from 3 to 5%, and that could affect you. Just I'll only deal with it now. If you are one of those that is lucky enough to be able to buy before you sell, instead of it costing an extra surcharge of 3%, it will be 5%. So the bill will go up more, although clearly when you've eventually sold it within, I think, 2 or 3 years, you can reclaim it. And obviously VAT on school fees, which again is cascading down. Well, how does it affect special needs, private schools, etc., etc.? I haven't finished there. The list gets longer. I do apologise. Sorry, I missed a slide. So there, and my last one is vapours. That's for my children. You've never had it taxed before on vaping. It's now going to be taxed from a couple of years out, and quite right. It's one move I completely agree with in the budget. The headlines are, it is tax and spend. It is Labour, as many of you knew from the 70s. Taxation up by 40 billion, very well flagged. Expenditure spending up way more than that, about 70 billion. And clearly the huge amount of increased borrowing. And so we get to the headline that it's the highest tax burden confirmed in a few years' time that we've seen since the post-war period, 38p in the pound. Now, I've got a very dull-sounding person, the head of the OBR, just going to give you 2 minutes of what they've said, which is quite factual, but quite interesting.
We've just published our October 2024 Economic and Fiscal Outlook. Against a largely unchanged economic and fiscal backdrop, today's budget delivers a large, sustained increase in spending, tax and borrowing, a temporary boost to the economy, and a new set of fiscal rules. Here are 5 things you need to know. The new government's budget increases spending by £70 billion per year over the next 5 years. 2/3 of this goes on day-to-day spending, while 1/3 goes on investment. This means the size of the state as a share of the economy now settles at 44% by the end of the decade, 5 percentage points higher than before the pandemic. Just over half of this is funded by an increase in taxes, which raise £36 billion a year in extra revenue, most of which comes from an increase in employer national insurance contributions. These and other tax changes take the overall tax burden to 38% of GDP by the end of the decade, its highest level on record. The other half of the increase in spending is funded through extra borrowing, which means that total government borrowing falls more slowly and is around 1% of GDP, or £32 billion higher a year over the forecast. The extra government borrowing delivers a temporary boost to the economy, with real GDP growth rising from 1.1% this year to 2% next year. But budget policies leave the level of output largely unchanged in the final year of our forecast. To make room for this extra borrowing, the government also sets itself 2 new fiscal rules over the next 5 years. The first one is to balance the current budget, or the difference between day-to-day spending and revenues, which it meets by a margin of £10 billion. The second one is to get its net financial liabilities, or the difference between its debts and its financial assets, falling as a share of GDP, which it meets by a margin of £16 billion. And you can find out more in our October 2024 Economic and Fiscal Outlook.
So we're going to have a quick quiz now to make sure you've understood all of that. What's quite interesting, I'm going to give you 2 sets of quotes from one a very famous economist and one a very famous journalist called Martin Wolf from the FT. I put it in our sort of quick synopsis. Martin Wolf from the FT yesterday said, "The budget marks a burial of Thatcherism. It also heralds a permanently bigger state. Increased taxation, increased borrowing and increased spending are more synonymous with a decidedly old Labour government. It is clear the Labour government have a dire legacy, and in the next 5 to 10 years, it will be 5 to 10 years, we will understand if the moves in the most significant budget for many a year will be beneficial to the country." And it's a sort of the feel that something very significant has generally changed. Roger Bootle, writing in a slightly right-of-centre newspaper called the Daily Telegraph, 3 interesting facts, because he feels a lot of part of the budget was misdirected. So from the Office of National Statistics, productivity in the public sector is now 7% lower than it was in 2019, and yet public sector pay is likely to be about £20 billion, or 9% higher than it was only 3 years ago. So huge more costs, lower productivity. On benefits, benefits have doubled. The expenditure on benefits in the various benefit budgets has doubled in real terms in the last 20 years. It is up by 20% just since the pandemic, pre-pandemic years of 1920. And lastly, in terms of economic inactivity, quite alarming, it's a statistic most of us have heard, the share of 16 to 64-year-olds not in the labour force, not able to work or seeking work, is 22%. So 1 in 5 of 16 to 64-year-olds that can work appears not to be working. And I guess many of you may have had this letter, important information about changes to the winter fuel payment. Did you all get that letter? You see, this is where I have a slight problem. I'm trying to be as non-political and as I can. So we think there's about between 10 and 12 million people in Britain that got this letter. You all know what a second-class stamp costs. I had to look it up. It's 85p. That's £10 million to get that letter. And so I think many people don't mind an extra element of tax. It's how it's used. And that's what, in a way, Martin Wolf is saying. The crux to all of this is going to be what actually comes out of it. And so the key takeaways are it's very much front-end loaded. So the benefits will be seen in the nearer term. Their spending plans are actually very flat from 3 years out onwards. So there's a deep concern that they may have to come back for more taxation. That Avoshi denies everything. There may be high levels of taxation. The margin for error that's just been quoted is only £10 billion, which in the big scheme is very low. And Luke may touch on it. The 10-year gilt yield has gone up quite a higher amount, and that's already taken £2 billion out of the shortfall. In a government seeking growth for employers, they're losing obviously 1.2 in national insurance, extra contributions. Employee rights, Angela Rayner's thing, making it much harder to do things with employers. You could argue it's good or it's bad, but from an employer point of view, more difficult to move around staff. The increase in the minimum wage, it's going to make it much more difficult for the private sector to bring growth. And one of the takeaways of a substantial borrowing going on in the economy and the investment of that borrowing is it could be narrowly inflationary in the short term. And that means we will find out next Thursday, a week yesterday. We think the Bank of England, from having a 100% chance of dropping rates next Thursday, that's down to 90%. But over a 12-month consensus, before the budget, we thought rates were going to be 3.5 to 3.75 out in 1 year. That's gone now up to 4%. And it's not just something in the UK, we'll talk about the US later, but we think that therefore there will be a reduction in the fall of interest rates from what was expected, and that for business, if their borrowing costs aren't going down as quickly, it is not particularly good. So a whole number of significant events from the macro point of view, and it does feel from the picture behind Rachel Reeves in number 11, which was before Nigel Lawson, and now it was one of the founders of the Communist Party in the UK. It is a clear sea change which is going on around us. How much further it will go will really be the telling point. So let me quickly whip through now the basics. But we did this in March, and not a lot's going to change. The personal allowance, the positive news is that the personal allowances and the income tax allowances are now only frozen to 2028, and they have announced that they will be reviewed. I think it's close to the next election. But that is something that is reasonably positive. The allowances, as I said, unchanged. So broadly, if you're just over £50,270, then you're in a high rate band. Fiscal drag is what it's called. As your state pensions rise, as your occupational pensions rise, you earn more. The allowances are kept the same, so you are paying more tax. And for most of you, because the all of you, the state pension is not taxed at source, so that's using more and more of your personal allowance up, which is why then your pensions are affected. Your occupational pensions have a higher amount of tax taken off them. And that then also rolls over onto the personal interest allowance, where the amount of tax that's then taken dependent on your tax band, you will pay further 20% of tax. And what we're beginning to see more and more is dividend allowance at the very bottom, 1.1 million people now, extra people paying dividend tax, with the dividends down to just £500. So you've got this sort of congregation of people that are paying more tax in any case, but more now on interest, which I'll return to, and dividends. And therefore, how are they going to get this tax? It's quite interesting, because the revenue are not geared up to get at most people who are retired in the basic rate tax band, and yet many of you may earn dividends of more than £500, or if your basic rate interest of more than £1,000. And the answer is they don't really want to know unless your interest is over 10,000, is what HMRC said in the last year, and otherwise they will go for you through your pay-as-you-earn coding notice. And so this is something that we're really happy to help with. So your coding notices normally come out in January, February, and they may show a change. We're happy to have a look at those for you, but what you'll need to do is have maybe a document somewhere that just summarises what interest did you earn in the tax year that ended April 24, the current or the last tax year, because let's say it was £2,000 and your basic rate taxpayer, you owe an extra 20% on the excess over the 1,000, i.e. £200. And so we will then check that the coding is effectively reflecting that, which means in English you'll have £200 of tax taken monthly through your pay-as-you-earn coding. So it'll hurt your sort of net income going forward. So something to watch out for, nothing to do with any great changes. This was a conservative thing that's just kept going, but it will end in 2028. And the interesting thing going back to it is at 4.5% interest, you only need about £22,000 of capital at 4.5% to give you 1,000. If your basic rate, it's about 11,000 clearly if you're a higher rate. So you don't need a huge amount of capital getting a semi-competitive interest rate to then pay higher levels of tax or more tax down the road. And what isn't changed, and I can't understate the importance of ISAs. Many of you have filled up with ISAs. We were quietly worried they'd put a cap on ISAs, they'd say no more contributions. We even worried that they may get rid of the very valuable benefit that when the first spouse dies, it can be transferred, the ISA of the deceased, to the survivor and retain its tax status. All of that remains, which is fantastic. The UK ISA that was announced in Jeremy Hunt's last budget has been binned. The UK is binned. The allowance, they've confirmed the 20,000, the 9,000 junior ISA, the lifetime allowance they are all frozen. That's been announced till 2030, but at least they are still there. And the significant advantages you can obviously have by continuing to shelter 40,000 per married couple, 20,000 per individual. And the key, thankfully, all of you do it with us, is to do your ISA at the beginning of the year. Never understand anyone that says, I want to pay lots of tax during the year and then I'll save a bit at the end of the year. Do it at the beginning of the year. We will send you the relevant paperwork and it's relatively simple and straightforward to do. So no real change there, except to accentuate the advantages of hiding some wealth. So this is a slow burner, but a very significant. John and I have got used since 2015 with clients of a reasonable amount of wealth who've got an estate over £1 million in retirement to say, take wealth from your taxable estate first, bring your estate down, that saves inheritance tax, leave your pension, that can be passed on to husband, wife, and eventually the kids free of inheritance tax. That's changing. Very significant change. From April 2027, there's a very juicy consultation paper. Very interesting because the Tories have rushed through the ending of lifetime allowances, got the legislation badly wrong. So they're giving themselves 2 and a bit tax years to implement this, and quite a lot of detail which will be gone through. So this is something that, one, hasn't changed, but will change. For those of you that are not in the public sector and have defined contributions pensions, who are in drawdown or have spare little pots, it's very significant, and we will talk you through it as more and more of the legislation becomes clear. But there's no need for immediate action as it's not going to come in for a couple of years. Everything else remains the same. So, horrible to say, if someone dies before the age of 75, it's still free of tax, it's still free of inheritance tax, but obviously the signpost is that it's all going to change. And it's going to get a bit complicated because what is clear is that the executors of a deceased estate are going to have to liaise with the pension company the pension company will be responsible for settling the tax on the pension directly with HMRC. But John and I only know too well, you ring up, I better not name certain pension companies, you could be 4 to 6 weeks before you even start to get a response. And yet the executors who already are dealing with probate, which is not the quickest thing going on in the world, are now going to have to deal with this extra organisation to combine and decide what the IHT liability. So one of these classics, it's fine in theory, it's going to be a little bit more difficult in practice. And what we've said here is, I think, for everyone that has got a reasonably substantial defined contribution pot, it's certainly going to have to be reviewed what the strategy is. For those that are just taking in from the pension and need it, I don't think much will change. Maybe the ratios of what you decumulate. But for those who it's a bit of a luxury and it wasn't there for their own retirement planning, it was going to be used for IHT planning, that's going to change. There's no doubt about it at all. What isn't changed is if you are in work, then you still get high rate tax relief. Seems a bit odd that if, with everything that's changed, that the well-paid get more tax relief. Could it be that MPs are high rate taxpayers, judges are high rate taxpayers, consultants in the NHS, police chief constables, and it just seems no politician is able to bring down high rate relief. So you've got some very generous reliefs. And for those that can afford, there is no doubt that if you can put money into a child or a grandchild's pension and get that compound returns over 10, 20, 30, 40 years, it still remains the only way, the best way to build some wealth to then give income in retirement. So the world of saving for retirement hasn't changed. It's just what happens on death. And in hindsight, probably the rules were very generous, really, and they've been brought to the defined benefit rules. So as you all know, if you've got a nice pension as a teacher, doctor, nurse, it can go to your spouse, maybe at 50% benefit, and then it's gone. And all we're doing here is the defined contribution world is coming more into that same regime. Capital gains tax, this was already pre-released. It is causing problems. 3,000 is the annual the annual capital gains tax exemption only. You don't need, say, 60,000 making only 5%, that's £3,000 of gain. So more and more, as we said in March, of the normal investors with taxable portfolios are coming into this area. And then widely marked, the increase from the old rates of 10% if you're a basic rate taxpayer up to 18%, and if you're a higher rate taxpayer, 18% up to 24%. And those are immediate. So it was widely flagged this was going to go on. Not quite as bad as some had thought. There is a theory that if you raise these sort of taxes by more than 6 or 7%, you get less because people just don't do it. So one obvious thing, capital gains tax, capital gains are only paid when you decide to sell something. As I'll come to the Jeremy Clarkson quote later on, you've only got 4 years, 9 months to wait, but that's depending on the next election. So very significant change there. Property sales, they've not touched it. It's 18 and 24%. And with property, and only with property, second property sales, you've got to settle that CGT liability within 60 days. Not so with shares. Shares are part of your self-assessment return. So a higher level of tax affecting more people. We did take some clients through taking some 10% hits because they were going to need money in the next 5 years. But most people, hopefully with the CGT exemption at 3,000 each, we can shift it and minimise it and work it carefully as we go through each year. So the nil rate band has been frozen for inheritance tax from 910 at 325,000. Don't forget, 10% of your wealth to charity, you get 10% off IHT. That's relevant for a lot of people who are interested in it. And then you've got the residence nil rate band. So as long as you've got direct descendants, they can be stepchildren, and your wealth, whether you own the property at death or whether you've moved into a care home or gone into rented accommodation, as long as there's a trail, you should be able to get the additional 175 residential nil rate band. Add that to the partner in a marriage. That's where the £1 million broadly comes from. Very simplistically, if you have children, you've got about £1 million before you pay tax. If you don't have children, it's just the 325 each as a couple, 650. But again, don't forget what they give and they take away. Once your estate's over 2 million, for every £2 over, you lose £1. So nothing's changed there, but the nil rate band is extended out. It was a very clear message. It is extended out right to 2030. So although they're changing the income tax thresholds at 2028, they've confirmed that they are extending the frozen IHT allowance. So the number of people paying inheritance tax in the UK is just swelling all the time. And then these were, quite interestingly, really, I think, quite unexpected and actually not raising a huge amount of revenue. So that the ability of businesses and farms, qualifying businesses and qualifying agriculture, to pass on the wealth on the basis that the wealth is contained not in cash, but is contained in land or shares of a business. They don't have great liquidity. You know, there's no sort of pound fountains coming out of a field in North Yorkshire. And they will now, going forward from April 26, this will change. The first £1 million will be allowed to be passed without any, they'll get 100% relief. Anything thereafter is going to be 50%. And for people that don't have liquidity, farms widely publicised, profits about 1% of asset value, maybe 2%, not a great deal of cash. Where are the children who've worked on a farm going to find the money to actually pay that liability? Which actually, what's the farm doing? It's feeding people in Britain. I get quite passionate, as you can tell, and I literally don't think Westminster understands. Maybe that's been nice to them. Maybe they do understand. And the word vindictive has been used a lot, not just in the right-wing press. So very significant change, not just for farms, but for businesses as well. You know, a family-run business, or even just a normal business, you don't need too many asset values and too much turnover to have a valuation on the shares at £1 million. They've also hit people when they sell businesses, with the rate of tax going from the business asset sales from 10 to 14 and then up to 18 on the first million. And as I said, the unspent pensions, as it's called, whatever's left in the pension being part of your estate for inheritance tax purposes. So what's quite interesting on the periphery, there's a lot going on there. There's a very significant change. I'll come back to, well, what's still there is you can still gift, and if you survive 7 years later, it's out of your estate. You've still got the £1 million for married couples. You've still got the residence relief. You've still got the deed of variation. You've still got the gifts out of income, which we think could become quite significant, that people will take more income from their pension, give it regularly, it's immediately outside the estate. So although there are some very significant changes and the sense of direction doesn't feel very nice, there are still quite a lot of things that are available and can help you decide, and actually outside of farming and business, you can still call it the voluntary tax. Those businesses possibly no longer are they able to do so. So again, quite a sea change going on there. State pension, we talked about the winter fuel allowance. Ironically, it's gone up by more than they saved on the winter fuel allowance. And it's gone up by 4.1%. What's interesting, if we get another rise around that level in 2026, it will be very close to the personal allowance. And we are likely in this current Parliament, unless they change the thresholds, to see people's state pension being higher than the personal allowance, which will cause chaos because they don't tax at source the state pension. So we'll have to wait and see. But that's gone live, that's going live, that's a triple lock, and actually they committed, the Labour Party, in the budget to maintaining the triple lock. And it's a triple lock because earnings have gone up by 4.1%. CPI is only 1.7%. So you're getting a higher raise than just the normal CPI at the moment. So I think my not so positive points, I mean, it's not negative, it's not so positive, are fairly obvious. The burden and the change that Martin Wolf referred to, it does feel like a significant moment in British political history. You know, it does feel like we are going back. It was Lamont's budget in 92 that was the largest raiser of taxes before this, and then obviously many remember the 70s. So it's going to feel gradually a little bit tougher. I think for people in retirement, the inflation spectre of what's going on could be quite worrying, and quite significant changes in the CGT and inheritance tax. The continuation, I think that businesses, it's going to be interesting, but where the growth is going to come from, that the Labour Party so passionately need, they're going to do quite a bit clearly with the borrowed money and the increase in taxes to get investment going. I think you can go all the way from Euston now to Birmingham on HS2 rather than the station stop outside London. They've talked about the Trans-Pennine Railway yet again. So there is going to be, you know, a significant investment in many areas. But outside of a public sector, how likely are businesses to be wanting to go hard at investment given these factual increased costs? And government debt levels are exceptionally high, at record heights. And as Luke may touch on, the cost of government debt has gone up. So it's a huge cost to carry. But when I say sort of a feel is nothing has changed with what many of you can do. And that's my positive takeaway. Actually, when you look at your affairs, you can do a great deal to fulfill your objectives. And I'll touch on this later on. So be clear about setting your objectives. What is it that you aim to do? Where do you want that outcome to look? And are you going to be stopped in achieving that? And I think for most of you, you're not. So there are still many, many positive areas. But clearly there are some sea changes in the political way. We are in big government, big state. And we're going to feel that for at least 5 years. And unless the Reform Party and the Conservatives get some sort of deal done, it's actually hard to see any change to the political situation even 5 years out, even with a very unpopular Labour government. And therefore, I'm going to hand over to the one and only Luke Pearce. And Luke, I'm going to highlight this, but immediately give him some comfort that he wrote this talk in October. And we now hand over at the beginning of November. So Luke, thank you for coming back.
Some of you are sort of smiling. I was thinking, I only wrote down one bit in the middle of that, and it's really that Richard can only sort of play the hand that he's dealt with, and it's tricky. I was fortunate enough to have a meeting on my own without Richard. That wasn't the fortunate bit, just before everyone turned up today. And the people I was having the meeting with very much pointed out the benefits that Richard has provided them since I think it was 2010, but for an awfully long time. He's very good at doing this, so you are very fortunate from that side. I'm also fortunate whereby I don't have to just chat about the budget. And as I come into, what I like to do is give a little recap of what happened prior to the last time that I chatted to all of you. And we came in to the start of this year with equity markets having performed quite well. This is MSCI ACWI. ACWI stands for All Country World Index. It's just the global stock market in simple terms. And we came into the start of this year with the markets having performed very well over the past 5 years. They've been up somewhere around 75%. So pretty pleasing stuff. Why had markets been doing well? Really because, as you will all know, inflation had been falling. So we had the whopping great spike in inflation back in 2022. Too much money had been printed to get people through COVID. They were locked up. They then went and spent a whole load of money, didn't care where they were spending it, combine that together with supply disruptions, and you end up with inflation. Central banks did a pretty good job of raising raising interest rates to try and slow things down, and the combination of that and the easing of supply chains got us back onto an even keel. So when we look back to March of this year, which was the last time that I chatted to a few of you, the main factors that were prevalent, inflation had largely speaking already been beaten. We were concerned about what was going to happen with interest rates. I'll come back to that in a second. There were fears about, following on from interest rates. Interest rates were hopefully going to be cut this year, and actually we've seen that. There were concerns that higher interest rates and higher inflation might lead to a recession. What was going to happen with AI? Politics was very prevalent. We've had a UK election since then. We've got an American election. I'll come back to the American election in a second. What was happening with China and what was happening with Japan? Broadly speaking, those were the right things to be focused on. I like standing up here and just being honest about where we were looking at things, and I'll do the same thing in a second. So we came into this year expecting what's called a Goldilocks situation, or a soft landing. Our industry can come up with great technical terms. What it really means is that inflation is falling, interest rates are going to fall a little bit. Economic growth slows, but it's actually fine. It tends to be a good environment to be investing in. Can be a volatile one because you always have those concerns hanging over you about whether that slowdown in growth is going to lead to a recession or not. And one needs to be very careful about managing one's expectations and keeping a close eye on that. But effectively, Goldilocks scenario should be good for investing, probably with a bit of volatility. As we look at this year, it's been about right, very pleasingly. So if we again stay on the MSCI world, we can see that, roughly speaking, this is going through to the start of, actually it's not, it's almost up to today, goes through to the 18th of this month. MSCI world is up about 17.5%. It's been a good year so far. There have been some bumps along the way, and I think it's important to pay attention to those bumps. So one was at the start of August, and the other was at the start of September. Why did they happen? We could chat about the yen carry trade, but I will really lose most of you in the audience, and I don't really think it was the most significant factor. What it really was concerns that economic growth might be slowing down and we might go into a recession. And I think that this chart is a particularly useful one. What it's really doing is showing what happens. The black vertical line going down is the first interest rate cut. Now, on the whole, central banks, and in this case the Federal Reserve, the Fed in America, when they're cutting interest rates, they're doing it because, in general terms, simple terms, they're feeling that inflation has been beaten, which is correct, but they also need to take some of the pressure off economic conditions to stop it slowing down too much. Now, if they leave it too late, you end up with the red line on this chart, i.e. what happens to investment returns coinciding with a recession. So they put too much pressure on for too long and you end up with a recession, and you end up with investment markets that are very flat to downwards. If they take the foot off the brake soon enough, early enough, you end up with markets performing very well, the green line. And there were concerns back at the start of August, start of September, that we were going to follow the red line. The reality has been that we have followed the green line. So far, investment markets, after those first rate cuts that happened back in the summer, have performed very well. Now, there are always concerns that we could go into a recession. I'm born and bred in Yorkshire, which can make me a little bit negative towards things. The reality is that investment markets should actually be looking at the economic data. So the recession probability data has been falling. So yes, we get concerned about things, but in fact, the chance of a recession has probably diminished as this year has gone by. I find that very hard to get my head around. We had very sharp increases in interest rates. It could have really put the kibosh on the world's economic markets, or not markets, the world's economy. It didn't do that, hasn't done that yet. We've had other data that's come out that has been positive. Jobs data, forget the jobs data that came out a day ago, last week. that got influenced from an American perspective because of the hurricanes that happened. If we go back a month ago, jobs data is still strong. People are still being employed. So the chance of a recession has fallen, and employment data is still holding up quite well. Now, what's been happening to global markets in general? I got ticked off by Richard earlier on today because you're meant to give quotes from famous people, and I make a hash of things because I don't have a script. I'm just standing up here and making it up as I go along. So I thought the easiest way of doing it was to give a quote from myself. Because actually it resonates with me. I think the future is uncertain. There are so many balls that are up in the air at the moment. Richard touched a few from the UK side of things. There are a lot that are happening from a global perspective. In simple terms, and going back probably to those Yorkshire roots, don't pay too much for it. So one needs to be conscious of valuations when one's going out and investing. This chart is quite a useful one. Now, Richard and I were chatting earlier on today, and I've been doing this. You dumb down how long you've been working for when you've been doing it for quite a long time. So I've been doing this for about 25 years. And throughout that period, I could have said at any stage, American markets look expensive. And they look expensive today. They're on the left-hand side there. What you can see is, if you look at the red diamonds, you can see where we are at the moment. So whilst American markets have always been expensive, they're really expensive at the moment. And it's not just the American markets in totality. It's not just the American markets in totality. It's not just the Mag 7, which I'll come back to. Even if you exclude the big tech companies, American markets look expensive. You can work your way from left to right across the screen. You've got China and the UK down at the end. They've always been somewhat cheaper than other markets. I'm going to touch on both of them in a second. But on the whole, I think it's fair to say there are concerns from a valuation perspective, and we need to be very conscious of that. Now, when we look at America, we need to be conscious of what has been happening. So if we look back to last year, 2023, investment returns were totally dominated by tech. Mega cap companies, the Magnificent Seven. When I say the Magnificent Seven, I'm meaning Alphabet, Amazon, Apple, Nvidia, Tesla, Alphabet, Meta. I can't remember how many I've said, but effectively 7 of them. Tech ruled the roost. And that's all the only place that you needed to put money into. Now, that was great if you were in there. As you came into the start of this year, people get swayed by recency bias. So they all want to go and buy tech because they think that that trend is going to continue. It hasn't done. Actually, year to date, I think that this still holds true. Tech pulled back a little bit last night. The broader markets, so the S&P 500, so the 500 largest companies in America, has outperformed the NASDAQ. So it hasn't just been those mega cap companies that have been driving all of the growth. It's come from a broader spread of the markets. That's very helpful for the likes of Richard and myself, and for you guys, because you all want diversified portfolios. You don't want to go and put all of your money on red. So things have done well. Yes, there are always concerns, but we had a useful quote. So Jerome Powell, who was chairman of the Federal Reserve in America, one of the most important people in the world, he's effectively turned around and said, the US economy is fine. If it starts to get a little bit worse, we will cut interest rates. There's an adage in our industry of don't fight the Fed. So if the Fed is tightening things, making things worse, be very conscious of that, don't pay too much. If the Fed's got your back, then you're in a strong position. And they very much turned around and said, we will cut interest rates if economic conditions require it. So very pleasing from that perspective. Now, AI, I am conscious of. I don't really understand that much about it. I think it can be transformational. I think it will be transformational. At the moment, we haven't seen those transformations feeding through into companies' bottom lines, and that gives a degree of uncertainty about what that brings. And that goes back to the question about not paying too much for it. I think it is very important that one uses professionals when one's making these decisions. I just want to give 2 companies, just as an example. So we turn around and say, oh, you need to be in chips, semiconductor chips, because they're going to be the requirement of AI and technology. 2 different companies, TSMC and AMSL. TSMC stands for Taiwan Semiconductor Manufacturing Company. Wow, that's long. you can see from the share price of the two of them that they have moved in completely different ways. TSMC makes chips for AI, AMSL effectively makes chips that go into other things. They are two different industries, so you can group them together and say that you want to be in semiconductors. You don't. You want to be in, well, you did want to be in TSMC. That's why I turn around and say you want to be using professionals to make these decisions. In the same way that you come to Richard for your financial planning, make sure you have the right people making those investment decisions. China. China has been an unpopular area to invest in really since COVID. Hearing someone coughing, it was almost on a cue there, because we blamed China either rightly or wrongly for COVID. We have blamed China for a lot of things. China has had a lot of problems. China's had a property crisis. It had COVID. It didn't have the economic stimulus, and it didn't come out of COVID with the same available resources to go and spend and get itself out. So the black line on here is the Hang Seng Index. I know that that's Hong Kong, but it's the easiest way of describing China. The red line on here is the S&P, i.e. in America. You can see that one's gone up and the other has gone down. That was until about a month ago. So China has had all of these problems towards its banks, its economic growth, etc. What they announced was a big measure of stimulus. Now, the details behind that stimulus are still to be fully announced. I can go into it at great length, but I'm not going to. You'll be glad to hear. But what is important to note is that the Hang Seng market, having been languishing for much of the year, actually was, I think still is, providing better returns than the S&P year to date. It's really important to have diversification within your portfolios. I think that China is definitely somewhere that you want to be watching next year. Do not regard that as a tip to go out and buy China. I think it's something that will be very influential behind investment markets over the coming year. The UK. Slightly feeding on from China. Japan, if we go back 3 years ago, I think it was about 3 years ago, announced some big measures that caused a big jump in the Nikkei, the Japanese stock market. Did some revolutionary bits that gave a good kickstart to things. China has just announced stimulus measures that have acted as another catalyst. From a UK perspective, we too have been languishing. So again, the red line here is MSCI World over the past 5 years. And then you've got the FTSE 250 and the FTSE 100. We've been a little bit in the doldrums over the past 5 years, and UK markets have underperformed other areas. In fact, year to date, the FTSE 250 had been doing okay. I haven't seen how it's done over the past, well, really since the budget, but the FTSE 250 had been performing okay, and smaller companies had, in theory, been benefiting from the fact that we were going to be having lower interest rates going forwards, which should be good for smaller companies. So we've seen a little bit of a boost. Now, the question is, we've just had the budget, and you just listened to a lot from Richard about this. My real point was, has this been the catalyst? And I don't think it has been, sadly. Or arguably it's been a catalyst in the wrong way. As Richard mentioned, we have seen an increase in yields. It's not the same as the Liz Truss moment that happened 2 years ago, but we have definitely seen yields picking up. It is likely that we will have higher interest rates for longer, and that's going to make it just difficult. We didn't get a Brit ISA. We didn't get any wonderful catalysts of change. In simple terms, I think the way that we look at it from an investment market perspective is the state going to increase productivity by more than the private sector would? I'm a capitalist by heart, and therefore I'm not going to answer that question. I think quite a few of you might feel the same way. So we will have to wait and see. The UK markets, from a proportion of MSCI World, are about 3.5%. We are very inconsequential in the grand scheme of things. I think it is important to have diversification. What are the other aspects that are influencing markets? I don't want to touch on this one to any great degree. We've had troubles in the Middle East. From a personal perspective, from a humanitarian perspective, I find it horrid. From a financial perspective, so far it has had very little bearing. The reason that I put out, this is the oil price. I've chosen 7th of October for logical reasons. And in fact, if one chooses that period from the 7th of October to the 7th of October, the oil price is down. Somewhat surprising, one would have thought that increasing tensions in the Middle East would have fed through to higher oil prices. It hasn't happened. So yes, it is something to be concerned about from a personal perspective. From a financial side, as of yet, it hasn't escalated, and long may it stay that way. The US election. Everyone's got a view on this one. I'm going to keep things really simple. Republicans and Democrats, roughly speaking, there is a 10% swing vote. Republicans will be born Republicans and will die Republicans. Democrats will do the same thing. There is a very small swing vote, no matter what the voting markets might say. We could chat about that, but it's not going to get very far. So there is a small amount, and we don't know exactly what's going to happen on Wednesday when the results come out. There are certain things that we have been guided on already. So it is likely that Trump will be more protectionist. So it's likely that he will look to deport people. It's likely that he will pump more money into the system. Both parties will be pumping money into the system. Trump is trying to put more money in than Harris. All of them are likely to be inflationary. So my gut feeling, if I had to give you a takeaway about what happens or what one needs to be conscious of from an American election side of things, it's not what happens in America. It's going to be what happens in France, probably over the next year. And if you needed somewhere to go and watch, it would be France. The reason that I say that is down to that inflationary aspect. So it is likely that we will have higher interest rates. Those higher interest rates, whilst, yes, they are happening in America, will feed through to all global markets. And France has got a pickle. So France has a debt issue. Arguably, it would devalue its currency, but it cannot go and do that because it's part of the euro. And therefore, France has a problem with higher interest rates going forwards. We think we have an issue. It's nothing in comparison with France. So keep an eye on France as a tip going forwards to next year. From an American perspective, I think that this chart probably simply sums things up. So the red lines and the blue lines depend on which party is in control. You can see that pretty much, and it goes back to 1960. So we've had quite a long period of time. Broadly speaking, the markets have gone up irrespective of which party is in power. We'll have to wait and see. Fingers crossed that that stays that way. One last bit that I wanted to chat about, because quite a few people hold gold or are conscious about what's happening with the gold price. The gold price has made whoopee this year, and in fact, over the past 3 or 4 years, it has equally been performing very well. What are the reasons for it? Keeping it very short, concerns towards what's happening in the world. Was China going to go and invade Taiwan? Is the Middle East going to implode? Is Russia going to drop a nuclear bomb? Whatever it might be. You've had concerns towards rising debt levels, which undoubtedly have increased and should be something that we are very, very conscious of. Lower interest rates mean that the cost of carry, so the cost of holding gold, has become less. And we have seen a lot of central bank buying of gold. That is now feeding across to retail investors. Retail investors tend to have a herd mentality. So if they see something going up, they want to go and join it. Yeah, it makes sense. The problem is that where the fair value bit is. So gold has been performing very, very well from that side. Just to give a summary of where things are or what to be conscious of, inflation currently is at central banks' target. So yes, it may be a smidge above the 2% target, but broadly speaking, it's where they want it to be. My view is that the risks are that inflation will be higher rather than lower as we look forwards from here. I'll stick by that one, even if I have to come back to it in a year's time. But I think the risks of inflation are going to be higher, partly because we're seeing more money being pumped into the system and partly because of increased risk towards increased debt issuance are likely to keep both inflation and interest rates higher. Economic growth has so far been fine. As I said a second ago, I still find that slightly confusing, but I will run with it anyway because I think that that's great. And if central bankers have done what they wanted to do, that's brilliant. So that would be good. Geopolitical aspects are going to remain high. If we go back to the budget and in simple terms, there has been a difference between what people want and what people can afford. And that has caused the problem. So if we take a step back to inflation, suddenly people found that they couldn't afford to go on 3 holidays a year, even though they wanted to go and do that. People want a fantastic national health service, but they don't want to pay for it. I'm just choosing 2 very flippant examples. And I think that we need to be conscious of that. The press are going to keep on fueling this. Richard mentioned one newspaper a minute ago. That newspaper needs to come with a health warning. It's great, but it is quite a right-wing viewpoint. Do be conscious of that when you're reading these sort of things, or any other newspaper or news source. Be conscious of valuations, as I said a second ago. Watch that economic growth and have diversified portfolios, all of which you have through Richard. That is it from my side of things. So I'm going to pass you back to Richard to continue. Thank you, everyone.
Brilliant. Thank you. The unique Luke Pearce, unique in a very good way. Right, we want to have time for questions, so I'm going to keep my sort of general review relatively quick. Couple of things. I just want to touch on a couple of other angles on the US election, obviously next Tuesday. Just talk about interest rates and more personal things. Demographics, which I think are very important, which leads in indirectly to inflation. A little bit about St James's Place, which I concentrated on last time, and also just about the client survey. And then we'll break for Q&A, and we're going to have headphones and someone's going to go around with microphones, and we'll get all the questions. So if I just skip that, but go straight into this, it won't be quite as we expect. And what we show here on the left-hand side is that when Trump came in 2016, very much let's have oil. We're going to pump and expand the oil capacity in America. So immediately in 16, everyone thinks oil shares are going to do well. And in the middle graph, what happened in the next 4 years? Energy companies went down. And guess what? Clean energy went up. You then have Biden coming in 2020, saying we're not going to use fossil fuels, we're really going to go for solar, wind and everything else. What happened in the 4 years from 2020 to 24? The complete opposite. Oil companies did really well. So in a way, it refers back to what Luke was saying, that it actually doesn't really historically seem to make that much difference. And even if you have clear views, often they can be completely wrong. Now, what's interesting about the election and where you can just hone it is, frankly, you just need to go to Pennsylvania, because they have been brilliant in the last 13 elections in predicting, and it's not predicting, in calling the right president in 11 of them. And between, I think it was Pennsylvania, Arizona, Georgia, and Wisconsin, they got it right in terms of Trump in 16, and they all skipped to Biden in 2020. So forget about everywhere else. It is all about these sort of swing states, as they call it, but particularly those four. Now, what we are concerned about is not actually whether Harris wins or whether Trump wins. And both Luke and I have really talked about it doesn't seem to make much difference. There is a major concern that if Trump wins, but the Republican Party win the Senate and the House to give him a clean sweep, we're into the world of tariffs. And if that happens, Trump has been talking about 60% tariffs on a range of Chinese goods, 20% tariffs on a range of European goods, and seems to be a fundamental believer in high levels of tariffs, which has led clearly to inflationary concerns, which is why not just the UK 10-year gilt yield has risen, but also the same across the pond in the States. So don't just look out next week for who is the new president. Very importantly, look out for who wins the Senate and also the House of Representatives. And although generally markets move nicely post-base rate cuts, again, is that going to be the case when you have these other factors in play? And more domestically, interest rates, 5% current base rate next Thursday, so there's a lot of news next week. Election in America, announcement of the results on Wednesday. Thursday, the Fed and the Bank of England Monetary Policy Committee will publish their latest views. Confidently, most people expecting the rate in the UK to fall to 4.75. There is a further meeting in December. Certainly the expectations pre-budget, we may get 2 base rate rises falls in the UK. So where can you get your returns on cash? These are current, they will change. So whenever we are asked, we just make it a wealth warning. These are there. If you go today, what you can get. But if you leave it till tomorrow, they could change. And what's a very interesting bet is fixed rates. Now, fixed rates outside of cash ISAs, you've lost control of the money. The guarantees, the rate of interest won't change, but you can't touch the money. Within ISAs, fixed rates, normally you have to be able to touch the money, albeit with a 3-month, normally, interest rate penalty. So I think there is certainly an interesting discussion to be made to looking at the fixed rate markets, particularly if you have significant sums with banks. So I was with someone just last week who's got over £150,000 with a major high street bank earning 1.15%. So they could immediately guarantee for the next 2 years, regardless of interest rates, to nigh on quadruple that figure. So do look at this. Obviously, there's tax impacts. Premium bonds have already just dropped the rates from 4.4 draw rate to 4.15, as have income bonds and direct saver with NS&I. So rates are moving. Things are going to happen a lot more in the market now. Speak to John and I about it just to make sure that you know what you're doing there. And demographics. Why am I talking about demographics? You know, the changes in age. You can see here virtually every country from 93, 4 different timelines, 4 different boxes, all the same sort of thing. Everyone is getting older. Yeah, we can't avoid that, unfortunately. So what's the impact of that? Well, you're going to live longer than your parents. That's a statement. You can see both in 1951, 77 was the target age for a 65-year-old. It's now 88 for the male. It was in 51, 80 for the ladies. It's now 90 for anyone at that age. You may not want to hear that, but that's a fact. So what is that all about? I mean, we all know that. Luke's attested to it with the NHS. It wasn't built for this. Look at those differences. We've not had a debate about how the changes in demographics have or haven't reflected. And the reality is, and there's a very strange one here. So this talks about a range of countries, and the line is what the birth rate was effectively in 1960 and what it is now in 2024. And immediately you go to Korea. South Korea, something strange has happened there. They were having just under 6 children per couple, and that has shrunk to 0.78 at the top. But it's happening across the world. So not only is everyone getting older, but there are less kids coming in who are the workers of the future and generally pay for the retired's pensions. So huge changes going on, which really politics and the levels of tax and the services aren't really reflecting, or we're not really having proper discussions about it. So for you, the interesting bit is, well, what does this mean? So supply at the top of the demand and supply, you could argue that supply is reducing because there's less children, less adults coming into work. And you can argue that workers supposedly consume more, they're earning money, they consume more, so the demands change, so actually you bring down lower inflation. But there's a school of thought, maybe that's absolute nonsense. And this is a very long, quick chart to talk about consumption, looking at ages from when you're born to when you die, and broadly, particularly with spending on health, it's quite clear, as we're all beginning to know, when the hip, when the knee, when the cataracts come along, that actually it's damn expensive. That's before care and help and gardeners and everything, cleaners. But, oh, I've pressed the wrong button. Well, I've done that escape button that you told me not to do. Oops. Anyway, as it will get mended here, I was getting so excited. What we were about to come to is... Do I hand you this or?
No, you carry.
Fantastic. I hope this isn't on YouTube or whatever.
Down,
right, okay. So what I'm about to say, and I'll show you in a very dramatic style, is a demand and supply chart actually will show, as it does here, fantastic. So those supply still goes down because we've got less workers. Actually, demand from the retired generation, often now the wealthier generation, has gone up. And guess what? It's actually leading to inflation. And again, if you look here in the UK, the spending costs on health are just going through the roof. Now, that's the sort of public side, but it's a fact. And that's what the budget links to and everything else. And so the fear and where that links to you is the necessity for people as they go through retirement to genuinely feel concerned about the rising costs of areas that they're going to spend more money on, i.e. health, care. And therefore that's a problem because you need to retain more of your wealth perhaps, which is a problem because inheritance tax and the big state's going to want more of it. So they are all interlinked, and no real political party for the last 20 years has really dealt with it. Not just in Britain, but around the world, which is where it's interesting, Luke talking about France. In Europe, in America, these problems are all there. Okay, we're heading, well, oh, I nearly pressed the wrong button. Just two little slides on St James's Place, because we dealt with it at length. It appears that the rumours of our demise were somewhat premature. We're having a fantastic year. This was our half-year results. Our new chief executive, I think the share price went up something like 25% in a day. And literally just 2 weeks ago, the Investors Chronicle on the left and a trade magazine, Business Live, on the right, again reporting very substantial gross inflows into the business and pretty rude health. 184 or 188 billion pounds under management. I think the second largest advice firms are around 116. So the sort of high levels of publicity St James's Place have got negative publicity, for which I profusely apologise. They won't go away because we are a headline. We will report over 1 million clients by the end of the year, and so we're newsworthy. So I don't like to compare St James's Place to Man United, but basically we are news in the money sections. And even though there will be a lot of news about historic reviews of other firms next year, and we've dealt with ours and done it, we will still come back because we're the first to do it, and no one else has actually announced and followed through on what they intend to do and what their redress is. And thank you, a major, major thank you from us before we hit questions. On our website, we're very pleased to publish the last 3 reviews from you, our clients, 19, 23, and then this year's 24. Overwhelmingly very constructive, very positive reviews, which we take very seriously and thank you for. And again, when you look at where we are with that across most of our competitors, we're in a great place. So I make the time just before 20 to 12. I've got virtually nothing to say, but we did want to leave some time for questions. Doesn't mean there have to be. I guess Rebecca's going to come round with a microphone. So if you could just put your hand up and just pause. Normal rule, can you please just at the beginning have one question and let other people ask questions? And secondly, I guess for the room, try to not make it too personal and political. And then everyone can gain from the major benefits. So who's going to lead us off on questions, if there are indeed any questions? Right at the front. So if you can just wait for a second. And we've got microphones over here which will work, and come on.
I can shout actually, Richard.
Yeah.
Just to say, I understand sterling's falling at the moment, following the budget. Is it a good time to invest in foreign markets?
Yes.
Yeah, no, you've got a mic. The mic will work.
Working?
Yeah.
Brilliant. I've got to make a decision. So I'll say yes. not necessarily from a sterling perspective. The UK is 3.5% of the global market. Without trying to be political about what happened a couple of days ago, I think that we are still lacking a catalyst of change from a UK market perspective. There are a lot of other areas of the world that you can gain access to if we choose just tech, for the sake of things. America has great tech. And if that's an area that is going to provide growth, you would fare better investing in America than you would from a UK perspective. So I think it's important to have a diversified portfolio. The currency aspect, on the whole, isn't the dictating factor behind investment returns. So looking at it from an investment perspective. So sterling relative to the US dollar, i.e. the cable rate, sterling had been much stronger than the US dollar if we're looking over the past year. I haven't seen actually this week, but I know that it had narrowed by about 3% at the start of this week. I suspect that there's a couple of percent, so it's been inconsequential in the grand scheme of returns. From a company perspective, if you were running a business from that side of things, then exchange rates have a different bearing. But does that help from an answering of the question?
I think what I would bring it more personally, not is that diversification was one of Luke's key words. We will never make a bet on an individual market. We only, as Luke said, I think the UK is under 4% of world stock market capitalisation. We are overweight in the context for most clients because they live in the UK, they spend in the UK, and so on. But diversification is the key. And the final point is most of our managers are stock pickers. So they go to the stock and the company that they think is the best thing to buy in the pharmaceutical sector, whether that's in America, Saudi Arabia, Europe, Switzerland, or the UK, is in a way irrelevant. So I think, you know, there is an overview, and certainly from when we all started, it was 60-70% in the UK to where it is now. That's already been reflected. Next question. Yeah. Front row questions is great.
Richard, sorry, can I just clarify the position on BPR, the inheritance position there?
Yep. So
So things like Octopus funds are a leader in that area. Are they now subject to then a 20% basically IHT charge from today?
Brilliant.
Or is it from 2027? I
Right.
wasn't sure.
I'll translate the question if I can, Andrew, and then I'll. So what Andrew's referring to is business property relief, the changes, which is from April 2026. And what I think will become much more interesting for clients where it's appropriate is there are schemes that get business property relief run from 6 major providers that we use, of likes of Foresight, Puma, Octopus, and so on. And the good news, Andrew, is that they will fall into the £1 million threshold. So it's not a case of they are AIM stock and they'll straight away get 50%. So if the individual has values of less than £1 million at the April 2026, they will still get 100% relief. If the value, so it's not an answer about whether they do or don't, it's the value that the deceased has in those products. And I think John and I will be talking a lot more about those type of things as other loopholes are closed. Actually could answer that question, that's good. Couple more? No?
Many years ago, you used to be able to pay inheritance tax by 10 annual instalments over 10 years. Does that still apply?
Yeah, the ability to pay it over a period of time, subject to interest, which I'll come back to, remains. The caveat is you've got to pay 10% of the inheritance tax within 6 months, but then you've got freedom, subject to interest, to do that. They've sneakily and really horribly put the rate of interest up, and I've got to try and get this right. It's 2.5% over base at the moment. So currently it's something like 7.5%. They've raised it in the budget, it's one of the quiet things, to 4.5% over base. So you're paying 9.5% interest. So again, you go back particularly to agriculture, and you go back to businesses who don't have liquidity, they're actually not only making it hard, they're going to be taxed now, but they're actually going to charge them more interest as well. Bit nasty. You can release deposits before probate to settle the IHT. So there is a scheme now which all major banks and building societies partake, and we are able, with director approval, again pre-probate, to release assets to pay HMRC directly. So if everyone talks about it being a major issue, if there is general liquidity within the estate, it should be possible. Obviously, if it's dominated by property, farmland, or business assets, you've got no liquidity, you've got a bigger problem. One more question. Not been too political, has it? Well done, everyone. No? I won't wait if we haven't. Thank you, Rebecca. No, great. So all I want to say is one of the quotes in EFT yesterday was that the need for everyone to understand there is a significant regime change, far more than the Brown-Blair move away from the Conservatives is really coming through loud and clear. However, actually, when you look at your own affairs, your own objectives, the flexibility that your wealth affords you, the framework you've wrapped it in, and then obviously that of your own personal objectives, your age, your needs, and the wishes you have for your family, I think there's still many roads that can be used to fulfill what you want to do. But the need to discuss it, we know how busy we've been in October. I think the panic part of it will be over, but the need to say, right, how is this regime going to affect me, and what do I want to reflect, and what do I want to do, has substantially risen. We'll be delighted to hear and hope and talk to you about it. So thank you very much for coming. It's not all gloom and doom, but there's a lot of work to be done. Very good to see you. The great news, we will not be doing one of these in March, because that is it for budgets in the current year. And clearly there will be a detailed sort of synopsis with the Investor magazine, which will be going out not next week, but the week after. You'll get your calendars with that as well. And then we're on hand for the rest of the year and into next year. So thank you for coming. Have a splendid lunch in Harrogate or whatever. Hope the roads are a bit easier. And look forward to seeing you next year. All the best. I forgot to mention feedback sheets, which I always do. You have feedback sheets. Please just give them in if you do want to see us.